This quiz contains 4 questions intended to test your understanding of the materials we covered in this module. Question 1. The CDS curve for a reference entity is inverted with the 2-year CDS at 350 basis points and the 3-year CDS at 325 basis points. Which of these statements is correct? Make the same assumptions, conventions, use of terms, etc. as we did throughout the module. Here are your 4 possible solutions: A, B, C, and D. Solution to question 1. A survival probability is always higher the shorter the time period, since the concept of survival probability is cumulative. So for 2 years, it is higher than for 3 years. The inverted curve was shown in Chapter 2 to be consistent with a declining conditional default probability, meaning that the default probability for year 3 must be lower than for year 2. Therefore, the correct answer is A, as in Adam. Question 2. Of the following factors that can affect the pricing of a credit in the real markets, which is likely to increase the spread at which the credit trades relative to the risk-neutral model? A complex capital structure, a bullet maturity, membership in an index, illiquidity, a very long duration, a high correlation with other assets in institutional portfolios, and finally a price significantly above par. Here are the permitted answers: A, B, C, and D. Solution to question 2. A complex capital structure, illiquidity, a price significantly above par, and high correlation with other assets are all undesirable features that drive the spread upward. Conversely, a bullet maturity, membership in an index, and very long duration are generally, obviously with some exceptions, desirable features that are more likely to reduce or have little impact on the spread. Therefore, the correct answer is C, as in Charlie. Question 3. Which of the following statements is true of how you revalue a CDS contract when the CDS spread moves? The 4 permissible answers are A, B, C, and D. Solution to question 3. Discount factors derived from the risky curve are always smaller than they would be if they were derived from the risk-free curve, since they incorporate a survival probability multiplication factor that is always smaller than 1. Therefore, all discounting, whether of gains or of losses, at the risky curve gives rise to smaller results than discounting at the risk-free curve. Therefore, the correct answer is D as in David.
Question 4. You purchase $100 million of the 8% 10-year Alcatel subordinated bond, paying annual coupons and trading at par. You now turn to the CDS market to hedge yourself against any deterioration in Alcatel's credit and find that the only reasonable liquidity is in the 2 and 3-year CDS contracts, which trade at a spread of 100 basis points and permit you to deliver only senior obligations of Alcatel following a credit event. If your view is that a 1 basis point widening in Alcatel's senior spread would likely correspond to a 3 basis point widening of its subordinated spread, which of the following CDS hedges works best against your expectation that the CDS senior spread will widen by 50 basis points? You may use any of the worksheets to answer this question and should assume that all curves are flat, that the risk-free curve is at 4%, and that recovery values for senior debt will be 30%. Here are the 5 possible answers. Worksheet question 4 solution shows first the mark-to-market in percentage relative to par of the 2-year and 3-year CDS, and also of the subordinated bond in this cell J7, in each case relative to a 50 basis point increase in the CDS senior spreads. Note carefully the recovery value assumption in this cell D15 of 30%, as well as the risk-free curve at 4% and flat as instructed. And finally, but very importantly, the application to the subordinated bond of a 9.5% discount rate, which reflects a spread widening on the bond equal to 3 times the 50 basis point spread widening assumed for senior obligations and for senior CDS, bringing therefore the applicable discount rate of the subordinated bond up from the original 8% to the 9.5% that appears here. These 2 cells down here contain the appropriate ratios of CDS contracts relative to the bond's notional required to offset the mark-to-market drop in the bond value with an increase in the CDS value. It should not be surprising that the ratio can be this high, and specifically 10, roughly, if we are using the 2-year CDS, and almost 7 if you are using the 3-year CDS. Since the price sensitivity, or DV01, or approximately duration, of the CDS instruments is far lower logically than that of the bond for 2 reasons. First, the maturity of the subordinated bond being 10 years versus the far shorter maturities of the CDS instruments, and second, the fact that the sub-bond is assumed to react 3 basis points as much per 1 basis point of widening on the CDS. And therefore, assuming a linear relationship, i.e. ignoring any convexity factors, these 2 cells confirm that the best hedges are therefore to buy protection on either 10.09 times the bond's face value via the 2-year CDS, or 6.93 times the bond's face value via the 3-year CDS. Therefore, the correct answer is A, as in apple. If you got one of the other answers and are wondering where you may have gone wrong, then most probably you have failed to incorporate here the correct RV, or failed to incorporate the correct risk-free rate, or possibly as a third alternative, failed to use the 9.5% discount rate and used perhaps instead an 8.5% discount rate to price the sub-bond, which would have missed the 3-to-1 relationship that the question instructed you to assume. This completes this chapter 4 as well as part 2 and the entire module.